Federal Reserve wrapped up its two-day meeting on interest rates. Since last year, the board raised interest rates 11 times to ease inflation, but it hasn't increased rates since July. Bradley Blackburn tells us what the Fed decided to do this time.
With consumer prices cooling, the Federal Reserve is leaving interest rates alone.
We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature.
Over the past 2 years, Fed Chairman Jerome Powell and the board gradually pushed its key rate to a 22-year high to fight inflation. A report out Tuesday shows inflation has dropped from 2022's peak of 9.1% to just 3.1%. This is the third time in a row the central bank decided against another hike. The question now, when will the Fed start cutting rates? Economic projections from the board point to the possibility of 3 small rate cuts in 2024, but Powell wouldn't offer a timeline.
These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust.
It's hard to predict that right now.
CBS News business analyst Jill Schlesinger says the Fed wants inflation at just 2%. For that to happen, the economy needs to weaken, but businesses are still hiring and consumers continue to spend.
Despite the fact that everyone really thought we were going to be heading into a recession in 2023, the U.S. economy has defied expectations. And until we see the labor market slow down and the economy slow more dramatically, the Fed is not going to be in any rush to cut interest rates.
The Federal Reserve makes its next decision on rates in late January. Bradley Blackburn, CBS News, New York.